If I asked you right now what is stopping you from starting your business, there is a very good chance your answer would involve money. Either you do not have enough of it, or you are not sure how much you need, or you are waiting until you have saved a certain amount before you feel ready to begin. And I want to challenge that thinking directly, because in most cases, the money question is not the real obstacle. It is a symptom of a deeper problem, which is not having a clear enough picture of what the business actually needs in order to get started. Today, we are going to fix that. Welcome back to the Business Foundation series. This is episode 8, and we are entering phase 3 of the series, which is all about money and the legal side of running a business. These are the real-world topics that most people ignore until it is too late, and then wish they had understood from the beginning. If you are new here, please start from episode 1. Each episode builds on the last, and this one will make the most sense if you already have a validated idea, a customer profile, a one-page business plan, a chosen business model, and an understanding of pricing. All of those are in the earlier episodes. Before we go further, if this series has been adding value to your journey, please subscribe and share this episode with someone who has been using money as the reason they cannot start. This episode might be exactly the perspective shift they need. By the end of today, you will know the truth about startup costs and why most people massively overestimate them, how to start a business with little or no money, what to actually spend money on first, and what to avoid spending money on early, and a real-world breakdown of startup costs for 4 different types of businesses so you can benchmark your own situation. Let us get into it. Let me start with a number that surprises most people. The majority of successful small businesses were started with less than $1,000. Many were started with less than $100. Some were started with $0 up front. Now, before you say, that cannot be true for a real business, let me explain what that actually means. The businesses that require enormous upfront capital are usually businesses with significant physical infrastructure. A restaurant needs a kitchen, a commercial space, equipment, and staff. A manufacturing company needs machinery, a factory, and raw materials at scale. A retail store needs inventory, a lease, and fixtures. But most of the businesses available to someone starting out today do not fall into those categories. And the reason most people overestimate their startup costs is because they confuse what they want the business to look like eventually with what it needs to look like to get started. There is a massive difference between those two things. A person who wants to start a photography business does not need a studio, a full range of professional equipment, a website with a custom domain, branded merchandise, and a professional editing suite before they take their first paid job. They need a camera, basic editing software, and one client who is willing to pay them to take photos. Everything else comes later, funded by the revenue the business generates. This is one of the most important mental shifts in entrepreneurship. You do not fund your business and then start it. You start your business and then fund its growth from the money it generates. I want you to hear that again. You do not fund your business and then start it. You start your business and you fund its growth from the money it makes. The businesses that raise large amounts of capital before they start, the kind you read about in tech news, are the exception. They are not the rule. And they often burn through that capital without ever becoming profitable, precisely because having money before you have customers tends to create inefficiency. Real example number 1. Sarah Blakely founded Spanx, the shapewear company that eventually made her a billionaire, with $5,000 of her own savings. She wrote the patent application herself. She cold-called manufacturers. She drove to stores personally to get them to stock her product. She did not wait until she had a factory or a marketing budget. She started with what she had and built from there. Real example number 2. Closer to everyday reality. A man in his 20s wanted to start a lawn care business. He had a lawnmower, some basic tools, and a few neighbors. He printed some simple flyers, knocked on doors in his neighborhood, and offered to mow lawns at a competitive rate. His startup cost was essentially zero because he already had the equipment. Within 3 months, he had 12 regular clients and was earning more than his part-time job. Within a year, he had hired his first employee. The point is this: most people are waiting for a funding situation that they do not actually need. The business they imagine in their head, with the perfect setup and all the bells and whistles, is not what they need to start. It is what they can work toward once they are actually generating revenue. So what do you actually need? Let us break it down. Every business, regardless of type, has 3 categories of startup spending. Essential spending, which is the minimum required to deliver the product or service to the first paying customer. Growth spending, which is investment in systems, marketing, or capacity that expands what the business can do. And vanity spending, which is everything else that looks good but does not directly generate revenue. The rule for starting out is simple: spend only on essential. Avoid growth spending until you are generating consistent revenue, and ruthlessly eliminate vanity spending. Vanity spending is where most new business owners lose money. They spend on a beautiful logo before they have a customer. They pay for a professional website before they have validated their idea. They buy branded stationery before they have made a sale. They rent office space before they need it. None of those things generate revenue. And in the early stages, every dollar you spend on something that does not directly help you find or serve a customer is a dollar that is making your business harder to survive. Now let us talk about practical strategies for starting with very little money or no money at all, because this is genuinely possible in more situations than most people realize. Strategy 1. Start with a service business. As we covered in episode 6, the service business model requires the least upfront investment of any business type. You are selling your time, skill, or expertise. You do not need to manufacture anything. You do not need inventory. You need a skill, a person who needs it, and an agreement to exchange money for a result. If you have a skill, whether that is writing, designing, teaching, cooking, cleaning, repairing, organizing, coding, photographing, or any other practical ability, you can turn it into a paying service today with zero startup cost. The very first thing you need to do is find one person who needs what you can do and is willing to pay for it. That is it. That is how the business starts. Not with a business registration, not with a logo, not with a website, with a paying customer. Strategy 2. Pre-sell before you build. We covered this in episode 3 on validation. A pre-sale means you offer your product or service for purchase before it fully exists. You describe what it will do, what it will cost, and when it will be ready. You ask people to pay or commit now. If they do, you use that money to build the thing. If they do not, you have saved yourself the cost of building something nobody wants. This strategy is how many physical product businesses get started with almost no money. They take pre-orders, use the pre-order revenue to fund the first production run, and deliver the product once it is made. No personal capital required. Real example: a woman who wanted to create a line of natural skincare products could not afford to manufacture an initial inventory. Instead, she built a simple social media following around her skincare knowledge, offered a pre-order at a discount for her first product, collected orders from 40 people, and used that pre-order money to fund her first production run. She launched with zero personal capital out of pocket. Strategy 3. Trade skills and services. In the very early stages, you can often get what you need without paying cash for it, by exchanging your own skills for what someone else has. If you need a logo, but you cannot afford a designer, can you offer something of yours in exchange? If you need photography for your product but cannot pay a photographer, can you offer your skill in return? Bartering is one of the oldest economic tools in existence, and it is just as relevant for a new business today as it was thousands of years ago. Strategy 4. Use free tools and platforms. The cost of starting a business in terms of technology has dropped dramatically over the last decade. There are free tools available today that would have cost thousands of dollars to build or buy just 15 years ago. Free website builders, free design tools like Canva, free communication tools, free accounting tools for simple bookkeeping, free social media platforms that give you access to millions of potential customers with no advertising spend, free video editing software. A new business owner who is willing to learn how to use these tools can build a professional-looking operation for almost no money. The investment is time, not cash. Strategy 5. Start part-time while you still have income. One of the most financially sensible ways to start a business is to keep your existing income source, whether that is a job or another form of income, and start the business in your available time. This removes the financial pressure of needing the business to pay your bills from day one, which in turn gives the business time to develop naturally, without you making desperate decisions out of financial fear. The goal is to build the business until its income equals or exceeds your current income, and then make the transition fully. This is slower than going full-time from day one, but it is far safer, and it produces better decisions at every stage. This section is extremely practical. I'm going to give you 2 lists. The first is what you should be willing to spend money on from day one. The second is what you should avoid spending money on until the business is generating consistent revenue. What to spend money on first. Number 1. Whatever you need to deliver your core product or service. This is non-negotiable. If you cannot deliver the core thing your business sells, you do not have a business. A cleaner needs cleaning supplies. A baker needs baking equipment. A photographer needs a camera. Spend here first, because this is what generates your income. Number 2. A basic functional way for customers to find and contact you. This does not need to be a professionally designed website with custom animations and a complex backend. It can be a simple free website, a well-maintained Instagram page, a Facebook business page, or even a WhatsApp business account. Something that tells people what you do, what you charge, and how to reach you. Number 3, legal and regulatory requirements. If your business type requires a license, permit, registration, or insurance before you can legally operate, this is essential spending. The specific requirements vary enormously by country, industry, and business type, which is why we have a dedicated episode on this later in the series. But if there is a legal requirement for your type of business, do not skip it. Number 4, your first real marketing activity. Once you have your first customer or two, it is worth spending a modest amount on reaching more people. This could be a small amount on social media advertising, a few printed flyers for a local service business, or a basic listing on a relevant platform or marketplace. Keep this budget minimal and track whether it is generating results. What to avoid spending money on early. Number 1, a premium website before you have customers. A website is not what gets you your first customer. Your network, your word of mouth, your direct outreach, and your ability to communicate your value gets you your first customer. A beautiful website is a tool for converting people who already know about you, not for finding people who have never heard of you. Number 2, a logo and full branding package. A logo does not make a business. Results make a business. You can have the most beautiful logo in the world and no customers. You can have a plain text name and 100 clients who love what you do. Brand design matters more as your business grows, but in the earliest stages, it is an expensive distraction. Number 3, office or workspace before you need it. Work from home, from a coffee shop, from a co-working space by the hour if you need it. Do not sign a lease and commit to monthly overhead before you have the revenue to comfortably cover it. Number 4, staff before you need them. Hiring too early is one of the most common ways businesses run out of cash. Employ people when the work genuinely requires more capacity than you alone can deliver, and you have the revenue to pay them reliably, not before. Number 5, stock or inventory beyond what you can sell in the near term. Buying large amounts of inventory to get a bulk discount feels smart, until you realize that unsold inventory is cash sitting on a shelf. Start with small quantities, sell them, and reinvest the revenue in the next batch. Let me now walk through 4 different types of businesses and give you a realistic, honest breakdown of what it actually costs to start each one. These are not the ideal, fully equipped versions of these businesses. These are the minimum viable starting points that would allow someone to find and serve their first customers. Business Type 1, a freelance service business. Examples include graphic design, writing, social media management, web development, bookkeeping, or tutoring. Minimum startup cost, essentially $0 to a few $100s. If you already have a laptop and internet connection, your startup cost is close to $0. You may need to pay for specific software, such as design tools or accounting software. A simple free portfolio website or LinkedIn profile costs nothing. Your first clients come from your existing network and direct outreach, not from advertising. You register the business when it starts generating consistent income, which we cover in episode 10. Total realistic startup range, $0 to $500. Business Type 2, a home-based food business. Examples include baking, meal prep, catering, or sauce and condiment production. This has slightly higher startup costs because of equipment and regulatory requirements. You may need specific baking equipment, commercial-grade containers, food safety certification depending on your country, and basic packaging. Many home-based food businesses can start with equipment already in the kitchen, adding only specific items needed for commercial production. Total realistic startup range, $100 to $800, depending on what you already own and what regulations apply in your market. Business Type 3, a local service business. Examples include cleaning, lawn care, delivery, handyman services, or personal training. The main costs are any tools or equipment needed to deliver the service, and basic insurance if required in your market. A cleaning business needs cleaning supplies and perhaps some equipment. A personal trainer needs a certification if not already held, and can train clients outdoors or in their homes initially, with no gym rental required. A delivery service needs a reliable vehicle, which most people starting this type of business already own. Total realistic startup range, $100 to $1,000, heavily dependent on what equipment you already possess. Business Type 4, a product business. Examples include handmade goods, imported products, or small-scale manufactured items. This has the highest startup costs of the four because it requires creating or sourcing physical inventory. However, the pre-sale strategy can reduce or eliminate the need to fund this inventory personally. If you can get customers to pay before the product is made, you are using their money to fund the first production run. Without pre-sales, a small first batch of a handmade product might cost $200 to $500 in materials. An import business requires enough capital to place a minimum order with a supplier, which can range from a few hundred to several $1,000s depending on the product and the supplier. Total realistic startup range, $200 to $3,000, with significant variation depending on product type and whether pre-sales are used. Now, looking at those four ranges, what do you notice? Even in the most capital-intensive example on this list, the product business, $3,000 is the high end of a minimum viable start, not $30,000, not $300,000, $3,000. For the other three types, which represent the majority of businesses available to someone starting out, the range is from $0 to $1,000. That is not a large amount of money. For many people, it is an amount that can be saved in a relatively short period of time, or in some cases, it already exists in what you own and what you know. The real barrier to starting is almost never money. It is clarity, confidence, and taking the first step. That is a wrap on episode 8. Here is the one thing I want you to carry away from today. Money is rarely the real reason people do not start. The real reason is usually fear, dressed up as a financial excuse. When you actually map out what you need to start, not what you need to eventually have, but what you need to get your first customer and deliver your first result, the number is almost always smaller than you imagined. Here is your homework before episode 9. Write down your business idea. Then, under it, write down every single thing you would need to serve your first paying customer. Not your 10th customer. Not your 100th. Your first. Put a realistic cost next to each item. Add it up. That number is your true minimum startup cost. Compare it to what you thought you needed before today's episode. The gap between those two numbers is the gap between where you are and where you need to be. And for most people, that gap is much smaller than they thought. If this episode helps shift your perspective, subscribe and share it with someone who has been waiting to start because they think they need more money than they actually do. You could be the reason they finally begin. In episode 9, we are going to talk about something that follows directly from today: money management for a new business owner. How to separate your personal and business finances, how to track your income and expenses simply, and what profit actually means, and how to calculate it properly. That episode will save you from one of the quietest and most common ways businesses fail. I will see you there. Take care of yourself and take care of that business.